A growing corporation faces a mechanical problem, expanding operations outward while maintaining executive control. In a centralized organization, decision-making is consolidated strictly at the top. As the firm scales, this creates a bottleneck. To survive, the company shifts to a decentralized model, pushing decision-making authority down to the lowest possible level so local managers can react to their specific environments. To structure this delegation, the organization divides itself into strategic business units, or SBUs. An SBU is a distinct responsibility center designed to facilitate local decision-making and measure the performance of its specific subunit. These centers fall into 4 categories based on the manager's authority. Cost centers manage only expenses, revenue centers manage only sales, profit centers manage both, and investment centers manage revenues, expenses, and the deployment of capital itself. Pushing autonomy down the chain introduces a severe behavioral threat: suboptimization. Suboptimization occurs when segments of the organization pursue goals that are in their own best interests rather than those of the organization as a whole. A local manager is evaluated and compensated based on their specific segment's numbers. If an action boosts their local profit but causes another division to lose money, the rational choice for the local manager is to take the action. They optimize their unit while actively cannibalizing the parent company. Management prevents this by engineering goal congruence. This requires designing performance measures so that a manager's pursuit of their own financial incentives directly accomplishes the organization's overarching strategy. 2 precise accounting levers exist to force this mathematical alignment: residual income and transfer pricing. Decentralization without strict mathematical alignment of incentives results in financial anarchy. You have to build the math to dictate the behavior. The investment center represents the highest degree of local autonomy. Managers here control revenues, expenses, and the actual capital invested in their division. Because they control the capital, the universally accepted performance metric for these centers is return on investment, or ROI. ROI measures operating income relative to the total assets deployed to generate that income. This table displays ROI across branches. Riyadh operates at a 7.8% return, outperforming Osaka's 6.4%. The anomaly? Osaka generated massive raw income. Riyadh only appears more efficient because nearly $10 million in total assets dilutes Osaka's return. Evaluating managers strictly by ROI creates a behavioral trap. If a manager currently maintains an 8% ROI, they will actively reject a highly profitable new project that returns 6% because adding it to their portfolio brings their average percentage down. By protecting their personal metric, the manager hurts the parent company. If the corporate cost of capital is only 5%, Mumbai also surges, generating over $59,000 in residual income. Shifting from percentages to absolute dollars guarantees that a manager will accept any new project that clears the corporate hurdle rate. The math aligns the manager's pursuit of a higher personal bonus with the parent company's pursuit of total wealth. Decentralized networks face another major friction point when Division A manufactures a component that Division B needs for its own products. They have to trade internally. The amount charged by one segment of the organization for goods provided to another segment is called the transfer price. Setting this price requires balancing a dual objective. It must motivate both the selling and buying managers to transact while simultaneously ensuring the corporation utilizes any unused production capacity. This decision tree maps the exact logic management uses to dictate internal transfer prices and shape division behavior. Consider a test scenario. Division A produces a part for $6, 4 in variable costs, 2 in fixed. The open market price is $10. Division B can buy a similar part from an outside supplier for $9.50. Returning to the flowchart, if Division A is operating at full capacity, the transfer price must be set at the full $10 market price. If Division A's machines are fully booked, they should not abandon highly profitable outside work to subsidize Division B. Division B must simply buy from their outside supplier for $9.50. If Division A has idle manufacturing lines, the mathematical incentives flip. With excess capacity, any negotiated internal price strictly above the $4 variable cost, say $5, benefits both managers. Division A generates $1 of contribution margin to help cover its fixed costs, and Division B saves $4.50 compared to their outside supplier. Transfer pricing is an active throttle. The parent company adjusts these internal rates to dictate where resources flow, ensuring the corporation captures maximum segment margins. Residual income and optimized transfer pricing solve the immediate mathematical requirements of goal congruence. Relying exclusively on these accounting metrics reveals a fatal vulnerability. They are purely lagging indicators. A lagging indicator is an output measure that only reports what has already happened in the past. Over the long term, a manager perfectly optimizing for residual income might slash their research and development budget or cut customer service staff. The current quarter's profits will spike, but the company's future market position will deteriorate. To protect against this, management implements the Balanced Scorecard. The Balanced Scorecard links financial outcomes directly to non-financial leading indicators. These KPIs are identified through SWOT and PEST analyses, tracking external threats and internal competencies to predict ultimate financial success before it hits the ledger. This strategy map visualizes the scorecard. Financial objectives sit top, driven by metrics below. The foundation is learning and growth. Increasing training improves internal business processes, lowering cycle times. This boosts customer satisfaction, decreasing wait times, ultimately driving increased profitability. Tracking these multi-tiered cause and effect relationships requires capturing vast amounts of operational data. An enterprise resource planning, or ERP system, is an absolute necessity here, integrating information from across the organization into a single cohesive database. A decentralized company operates as a highly engineered ecosystem. Human behavior responds strictly to how it is measured. Map the leading indicators to the long-term vision, design the math to reward it, and the corporate strategy executes itself.